Welcome back to The Explainer. Okay, today we are tackling an absolute monster of a myth. One that honestly paralyzes so many everyday investors and totally stops them from making their money actually work for them. We hear these two words thrown around the financial world all the time, right? Volatility and risk. And people just use them interchangeably. They see a price drop on a chart, their heart skips a beat, and they panic, thinking they are in serious danger. But here is the thing. They are not the same thing at all. In fact, misunderstanding the difference between these two concepts might just be the single biggest barrier to building long-term wealth. So let's dig into the data from our source material to see exactly why this is a myth and how shifting your perspective on this could completely revolutionize your financial strategy.
So let's just get right to the heart of it. Is volatility the same thing as risk? It sounds like a really simple question, but it trips up so many of us. A lot of people believe that if an asset is bumpy, if its price is jumping up and down day by day, it's automatically a dangerous investment. We're totally conditioned to want smooth, straight lines going up. But the source material completely busts this myth wide open. It points out that assuming a volatile asset is a risky asset is just a fundamental misunderstanding of how markets actually work.
Let's set the record straight right now with our core focus for today. Here is the bottom line. Risk means losing the value of your money, while volatility is just how fast the price of an asset changes compared to a fiat currency. That is literally it. Volatility just means the price is unstable and can jump around in a short period of time. Risk, on the other hand, is the very real, very actual danger that your money simply won't be able to buy as much in the future as it can today.
Section 1. Deconstructing market volatility. Why prices jump.
Before we can talk about protecting ourselves from actual risk, we kind of need to understand the noise of volatility first. Like, why does an asset even become volatile in the first place? Well, rapid price movements are triggered by a whole chaotic variety of short-term factors. We're talking about, unexpected political decisions, sudden geopolitical tensions breaking out around the world, or honestly, even just low market participation where a few massive trades can drastically swing the price. It's also driven by the levels of adoption of a new asset or sudden incoming financial regulations. All of these external forces act like these sudden gusts of wind, right? Just whipping the price of an asset up and down on the charts.
But here is the absolutely crucial point. All those crazy factors we just talked about, they mostly just affect the short-term price of an asset. It's really just noise. Because when you zoom out, the source material highlights a completely different picture. Strong assets tend to follow an upward trend over the long term, completely despite those bumpy short-term fluctuations. Think about it. If you let the day-to-day volatility scare you out of a fundamentally strong asset, you are totally missing out on that long-term upward trajectory.
Section 2. The real risk. Purchasing power.
Okay, so if volatility isn't the real danger we should be losing sleep over, what is? Well, the real villain in investing isn't a jumping price chart. It's the silent, invisible loss of your purchasing power. As our source reminds us, inflation happens because governments can, and let's face it, do, increase the money supply. And as that supply increases, your money literally becomes worth less, meaning it's going to buy you less in the future than it does right now. And that, my friends, is the true definition of financial risk.
And honestly, I think this brilliantly illustrates the real-world impact of that specific risk. Just think about this number, $15. 25 years ago, using a fiat currency like the US or Canadian dollar, you could buy an entire chicken for just one single dollar. Today, that exact same chicken costs $15. Now, obviously, the chicken hasn't inherently become 15 times better or tastier. Your money has simply lost the vast majority of its purchasing power over those 2.5 decades.
And because of this invisible thief we call inflation, we arrive at a pretty harsh truth. Simply holding cash is not enough. Keeping your money perfectly safe under a mattress or tucked away in a zero-interest checking account feels super secure, right? Because there's zero volatility, the balance never bounces around. But without that volatility, you are actually guaranteeing that you will lose purchasing power over time. You're effectively choosing the absolute certainty of slow impoverishment over the short-term bumps of real wealth creation.
Section 3. The illusion of profit. Not all investments protect you.
So to fight inflation, you obviously have to invest. But not all investments are created equal. Let's look at this data to build a clearer picture of true returns. Imagine you invest $100 each into two different companies, Company A and Company B. Both have innovative tech, both are small cap, and because of that, both are highly volatile. Over 5 years, Company A successfully builds its brand and your $100 turns into $1,000. Massive wealth increase, right? Awesome. But Company B struggles with the competition.
After 5 years, its stock barely grows, turning your $100 into $120. Now, at first glance, $120 looks like a 20% profit. You might sit back and think, hey, at least I made money. Until, of course, you pull back the curtain.
Because when we actually apply the reality of risk, which remember is inflation, that 20% profit is a total illusion. If inflation is running at around 3% per year and that compounds over those 5 years, your money needed to grow by way more than 20% just to stand still. So Company B's seemingly positive return actually means the investor lost purchasing power. In real terms, their gain is negative. Company B failed to even maintain the value of the original investment, which just proves that you can't just throw money at any volatile asset and expect to be protected.
Section 4. The power of diversification. The antidote to risk. Since nobody has a crystal ball, and we can't predict with absolute certainty which volatile asset is going to be the rocket ship and which is going to be the dud, what's the actual practical solution here? The answer? The ultimate antidote to true financial risk is diversification. This simply means strategically spreading your investments across a bunch of different assets. Instead of putting all your cash into one highly volatile place and just crossing your fingers, you act strategically. You allocate your money across different asset classes in specific percentages. This is exactly how you build a fortress around your purchasing power.
And it really just breaks down into a clear, structured approach. Step 1. Create a portfolio, which is essentially just a well-thought-out basket of investments. Step 2. Allocate your money across different asset classes. Maybe some equities over here, some real estate there, maybe some commodities. And step 3, by doing this, you drastically reduce the true risk of losing your money, hugely improving your chances to preserve and grow your wealth over time. You essentially just let the short-term volatility happen, knowing your diversified basket is fully structured for that long-term upward growth.
All right, so now that we fully understand the framework, the next logical step is figuring out how to actually apply it. In future explainers right here on the channel, we are going to get highly practical. We'll be specifically exploring the actual tools and accounts available in Canada to help you build these well-diversified portfolios effectively and efficiently. But before we wrap up today, I really want to leave you with this final provocative thought. Take a hard look at your own finances and ask yourself, are you guessing or are you planning? Because at the end of the day, successful investing isn't about closing your eyes and just hoping you picked company A. It is about deeply understanding that volatility is just speed, while risk is the actual loss of your money's value. It's about planning, structure, and systematically managing that real risk over time. Thanks so much for joining me on this explainer, and I absolutely cannot wait to dive into those practical tools with you next time.